Let's get more perspective on the outlook for the U.S. economy, because right now, Apollo chief economist Torsten Slok, he's outlined 10 downside risks. They include households running out of excess savings, student loan payments restarting, sticky inflation forcing the Fed to tighten too much, delinquency rates rising for credit cards, default rates rising for high-yield bonds and loans. So a lot to be worried about, but I'm thrilled to say that right now, Torsten Slok joins us. And Torsten, I actually want to start with number 10 on your list, which is long-term interest rates rising for non-economic reasons. That's really, it seems to be front and center in the market's mind. Will you just walk us through what some of those non-economic reasons could be?
Yeah, this is really important, Katie, because there's a very important debate going on. Why are rates going up? And rates can go up for two reasons. Long rates can either go up because Fed expectations are changing. In other words, if we suddenly were pricing in many more rate hikes, then of course long rates should also be going up. But that's not what has happened in the last several months. Instead, it is all these non-economic reasons why rates have gone up, or in different words, it's the term premium that has driven rates higher. And what are those non-economic reasons? Well, first of all, the US had a downgrade in August on the sovereign side. That's, of course, been a major change to what's going on in treasury markets. Also, we have seen significant issues with issuance of treasuries. Next year, going to grow quite significantly on average. Issuance of treasuries across the yield curve will be up 23%. There's a lot of debate in markets, and including on your shows, about what does all this supply of treasuries mean. And more importantly, we also have another list of things like Japan exiting yield curve control. We have China is having lower exports. That means fewer dollars to recycle. So there is basically a laundry list of all kinds of somewhat unquantifiable explanations why rates are moving up. And the most important issue in this discussion is if we finally get some bad data, say non-farm payrolls or say jobless claims, if rates don't go down, it will reveal that it is all these non-economic reasons why rates are moving higher. So that debate about why are rates going up, is it because of the economy or is it because of these other things? It does become really, really important in markets.
Well, when you put all of that together, what's the potential ceiling here for when you think about how far yields could actually rise, and you think about the economy at large so far resilient to those higher rates? At what point does that start to break?
Yeah, that's also really important, because think about it. For the last 5-6 months, the market has been pricing that the Fed is very close to the peak. That hasn't really changed. That's still the view today. We are now debating a little bit after retail sales. Well, maybe rates will go up and the Fed will hike again here in December. But broadly speaking, markets have still had the view that the Fed is not going to do much more than what they already have done. And still, long rates have continued to move higher. So to your question, Katie, what the really important question then becomes is, well, if the driver of rates has not been a change in the economic data, if it has not been a change in the outlook for the Fed, but has instead been a change in how the market views issuance of treasuries, how the market views Japan exiting yield curve control, the sovereign downgrade, even some issues about whether the market is seeing this as an unwind of the basis trade, some more technical reasons, those other reasons might begin to play a role. In other words, even if the data begins to weaken, issuance is still a problem going into next year. So therefore, it does become quite important. To your question, what is the ceiling? It depends a lot on whether rates are actually driven higher by the economic data getting better, which doesn't seem to be the case, or whether rates actually are going up for this laundry list of other things that are the causes of why rates might be moving higher.
I do want to talk a little bit more, though, about some of the, I guess, canaries in the coal mine, if you will, Torsten. Everyone's still looking at the credit market, and by credit, I'm talking about consumer credit right now. The idea that as a whole, when you look at delinquencies and some of the other charge-off measures, as a whole, they're actually not that bad relative to history. But then when you sort of break it out between some of the big banks versus some of the small banks, and you look at what the small banks are holding, it's eye-popping.
That's absolutely right, Romain. So here the issue is, I mean, what we should do in markets, and what we in my group spend so much time on, is trying to figure out what has been the impact so far of rate hikes on consumers, on corporates, and on banks. And if you look at consumers, exactly as you're highlighting, yes, we are seeing delinquency rates going up. And in aggregate, it may not look like it's going up in any significant way. But if you start looking at the New York Fed data for what's happening to delinquency rates for people on credit cards in their 20s, in their 30s, and in their 40s, what's happening to delinquency rates on auto loans for people in their 20s, 30s, and 40s, you're beginning to see that the level of delinquency rates at the moment is actually close to what we saw in 2008. So that gets to the point that even before the Fed has succeeded with pushing the unemployment rate up, we are already seeing, in particular on the consumer side, a rise in delinquency rates, as you're highlighting. Looking also at default rates for high yield, also going up. And likewise, bank lending is also slowing down in the weekly data. So the textbook would predict that the economy would begin to slow down by reacting with more people falling behind on payments on the consumer side, more corporates going bankrupt, and banks slowing down lending, and that's exactly what we're seeing in the data.
Do you sort of buy into this argument here that when it comes to economic conditions and the consumer, that there is kind of this tale of two cities where you have lower and middle income people that are actually starting to struggle, but you still have this huge cohort of upper income people that are comfortable and still spending, and that right now is the main pillar that's supporting this economic growth?
Yeah, so that is absolutely, I agree that here the issue is that we still have a lot of excess savings left by using the San Francisco Fed's methodology is roughly around 400, 500 billion that's left to be spent. And if the burn rate of that is about 80 billion a month, you get that in the next 3, 4, 5 months, we will get closer to the point where that excess savings will be coming down. And you're right, there are some distributional issues about where those savings are located. But combined with the households running out of savings and student loan payments starting here about 2 weeks ago, we are still seeing a fairly significant amount of downside risks, both from the Fed hiking rates and from consumers running out of excess savings and from student loan payments restarting. So the outlook for the next 3 months is more to the downside for the U.S. overall.